So the next category of adjusting entries that we're going to talk about is deferred revenue, right? So we know deferrals is when the cash transaction already happened. So we get the cash and then we earn the revenue later. So what do we call it when revenue is received in advance? This would have been an example. And this is from chapter 2. This is a transaction that would have been recorded during the period. The customer pays $1,200 for the next 4 months of accounting services. So we're getting $1,200 for the customer, and now we owe them accounting services. So we know when revenue is received in advance, we are dealing with a liability account, unearned revenue, because we owe services to that customer. So in this example here, when we get the $1,200, we're going to debit cash, we're going to credit unearned fees or unearned revenue. At the end of 1 month now, we've done some of the work, right? We owe them 4 months of service when we got the money, but now we've done 1 month of it. So we have to do an adjusting entry to show that we have earned the revenue for 1 month of the services that we've performed. And then we also need to show that we don't owe them those services anymore. So our liability unearned revenue is going to be decreasing. So we need to make an adjusting entry. So this is the adjusting entry, right? And I said the first step is always, are we dealing with a revenue or an expense? We're dealing with a revenue. And we know we record revenue by crediting it. In this situation, we credit the service revenue. Our debit will be the unearned revenue or unearned fees account because we don't owe the 1 month anymore, right? And 1 month was $300 because $1,200 was received for 4 months. So that means in 1 month time, we've earned $300. So that's the adjusting entry. So here's another example. So a very common situation for unearned revenue is gift cards. Companies sell gift cards, right? They get your money and then later you come back and you get the good or service. So an example that I have is the place where my husband gets his hair cut at Christmas time. They sell gift certificates. If you buy 4 gift certificates, you get 1 free. So he will go and he'll buy a bunch of gift certificates and then he'll just use them every month throughout the year when he goes in and get his haircuts, because then that way he's gotten a few free haircuts. So think of it that way. When the haircut place, I don't know what's it called, Hair Performers or whatever, when he buys the gift cards, they're debiting cash, they're crediting unearned revenue. And then every month when he comes in, now they don't owe him the haircut anymore. They will debit the unearned revenue and then they'll credit the service revenue because now they've done the haircut. So when we're talking here about customers redeeming gift cards during the period, so we're talking about revenue. When we're talking about our gift cards, we've earned revenue for them. The cash transaction, it happened in the past. It happened when they bought the gift card. And then the amount, here they told us already that the amount was $7,800. So our adjusting journal entry for this, we would debit unearned revenue and we would credit our service revenue. And so it's important that we make this adjusting entry, because if we don't record the adjusting entry for the unearned revenue, the revenue on our income statement is going to be understated. Our net income will then be understated. If our net income is understated, then you go to the statement of retained earnings, and our retained earnings will also be understated. So on our balance sheet, stockholders' equity is going to be too low or understated because retained earnings was understated. Our liabilities will be overstated because it's going to look like we owe services that we don't owe anymore. The next category of adjusting entries is accrued expenses. And when we're talking about accruals, that means the cash transaction is going to happen later in a future accounting period. So if we're talking about accrued expenses, the expense has been incurred this period. Doesn't matter that we're not going to pay for it till next period. we have to make an adjusting entry to get those expenses recorded because they need to be recorded when they have been incurred. So we have to make an adjusting entry to record that expense, and then we also have to record that we owe for it. We're not going to pay for it till later, so as of the end of the period, we owe for that expense. So a common example of an accrued expense would be your salaries expense or your wages expense. Because really, every day that your employees work for you, you're incurring salaries expense. But we don't make the journal entry every day. We had been in Chapter 2 looking at just recording the salaries expense on payday. And so that's fine if the pay period begins and ends in the accounting period. So if that happens, right, we debited wages expense or salaries expense and credited cash, right? And some companies have it set up where they pay their wages on the 15th and then the last day of the month. So that way they don't have to deal with accrued wages, all right? Because they're paying it, the pay period begins and ends. It begins on the 1st, ends on the 15th. The second pay period begins on the 16th, ends on the last day of the month, so that they don't have to deal with accruals. But like where I get paid every other Friday. So there's sometimes where the pay period starts in one month and ends in the next month. So we've got some overlap. And so we're going to have to make an adjusting entry when that happens. So Prairie State has to make adjusting entries for their salaries. Because if we wait until payday and debit salaries expense and credit cash, then all of the salaries expense are going to go into the next accounting period when some of the salaries expense had been incurred in this accounting period. So we have to make an adjusting entry to record the salaries expense that was incurred in this accounting period. Whoop, that's not what I wanted to do. Here we go. So here's an example. Payday is on Friday, so here's Friday, and we're going to pay wages of $1,000 for the 5-day work week. But when we look, Monday is actually the last day of the accounting period. We have to make an adjusting entry on the 31st to record the wages expense that was incurred in this month. The 31st is the last day, so we have one day of these wages needs to be recorded as wages expense in this month. So we make an adjusting entry. We debit salaries expense, we credit salaries payable. And $1,000, was for the 5-day work week. So that means $200 was the salaries expense for the 31st. So that's why we had a debit salaries expense, credit salaries payable. Okay. If, let's say, the 31st would have fallen on Wednesday of that week, then we would have needed to record it for Monday, Tuesday, and Wednesday. So it would have been 200 times 3. 600 would have been the entry if the 31st would have fallen on a Wednesday. Okay. So that's what we're trying to do. We're trying to record the portion of the wages that were incurred in this period. Interest expense is another common accrued expense. Okay. And we're going to get into calculating interest expense in a future chapter. Okay. So for right now, let's just talk about what the accrual would be. So in this example, we borrowed $24,000 on a 1-year loan at 10% on September 1st. Okay, so we borrowed on September 1st of this year. It's a 1-year loan. We don't have to pay it until September 1st of next year. Our fiscal year ends on December 31st. So on December 31st, we have incurred expense for September, October, November, and December. So when we're talking about interest on a loan, we're talking about an expense. And the cash transaction isn't going to be paid until September of next year. So since it's being paid in the future, we're dealing with an accrual. And so, as I said, we'll talk more about the calculation later. But we need to record 4 months of interest, right? So just kind of a quick, if we take the loan times the interest rate, that'll give you a whole year of interest. But we're not recording a whole year of interest. We're just recording 4 months. So that's why it's 4 over 12. So we have incurred $800 of interest expense as of December 31st for September, October, November, December. So we have to make a journal entry to debit interest expense. And since we're not going to pay it until next year, we're going to credit interest payable. If we don't make that adjusting entry to record our accrued expense, then our expenses are going to be understated because we haven't recorded all of them. And if our expenses are too low, that means our net income will be too high or overstated. If our net income is overstated, that means retained earnings is going to be overstated. And then our liabilities will be understated because it doesn't show that we owed the wages or the interest or whatever the accrued expense was. Our last category is accrued revenue. Revenue has been earned in this accounting period, but it hasn't been recorded yet. So the customer or somebody owes us at the end of the period. So we have to make an adjusting entry because if we have done the work and we've earned that revenue, we need to get it recorded as revenue in this accounting period. So some reasons why we might have accrued revenue. So one reason might be we just haven't done billing yet. Our billing processes, maybe we do our billing on Fridays and maybe the year ends on Tuesday. So we haven't sent out the bills yet. Another reason could be we have a contract and we're not going to collect until the project is complete. But under GAAP, if we have a stage of the project completed, we can record the revenue for that stage of the project. So we have to look at all of our open contracts and see, okay, we haven't collected because we're not done, but maybe we have a stage or a couple of stages done. Any of that revenue related to those stages needs to be recorded. Interest income actually would be another one. So the flip side. So if we have loaned money to someone, even though they're not going to pay us till the next accounting period, we will have earned interest revenue for the portion of time from when the loan started until the end of the period. So here's an example. Accrued service revenue, $1,000. Work has been performed, but we just haven't done billing yet. So we're talking about revenue in this situation. We haven't done the billing, so we haven't even asked them for the money, so we're not going to get the money until later. So that's why we're dealing with an accrual, and we were told the amount was $1,000. So when we make this adjusting entry, we're going to debit accounts receivable because our customer owes us, and we're going to credit service revenue because we've done the work. Another example could be we have investments that earned $1,800 in interest income. We're not going to receive the money until the beginning of next month, but we've earned it, so we're dealing with the revenue. The cash transaction, we're not going to get it till next month, so it's an accrual, and we're told in this situation that it's $1,800. So our adjusting entry, in this case, it's not going to be accounts receivable. Accounts receivable is when a customer owes you on account. We're going to call this interest receivable. That's going to be our debit. And then our credit will be to interest income. And this is important that we get this recorded because if we don't, our revenue will be understated. Our net income will be understated. That means our retained earnings will be understated. And then our receivable won't get recorded, so our assets will be understated. Now, after we've made all of these adjusting entries, we've learned about the 4 categories. Again, we make journal entries. The journal entries need to be posted. And then after we post the adjusting journal entries, we'll make one more trial balance. And this will be the adjusted trial balance. And it'll be done the same way, where we list the names of the accounts and the balances to make sure debit balances equal credit balance.